the EU.
Okay, thank you.
I'm looking at the financial stability report. There was some copies sent to us. Table BA, which has lists of things you think have dealt with. Then there's a section B, which is things which could go wrong in Europe, which spill over to us. And then you go over the page. When we translated all this legislation here, there's still problems around that, gaps, so to speak. There seem to be rather more of them than you've actually referred to already. I mean, are you worried about table BB, for example, other risks to disruption in financial services? Are you worried about the things on that list?
Well, from a financial stability point of view, we've deliberately ordered them, and the three I mentioned to you are the ones that, in our judgment, if they went seriously haywire, could actually lead to a financial stability problem. The others are lower down, but the one that I would pick out from the list that you're looking at is the payment systems issue. The big question of whether or not UK banks would be able to plug into EU payment systems, by which I mean Target 2 and SEPA, that has been solved. They can plug in, that will be fine. The issue that arises is a technical one, which Andrew and colleagues have also been working on, which is under the new arrangements, banks need a bit more information about the payer, particularly for direct debits. And the volume of those is quite high, and banks should be able to fix that in time, but if they don't, there is a risk that quite a lot of small payments get disrupted, which, although I don't think that should threaten financial stability, I think could be quite noisy. So that's the one I would pick up.
I think it's fair just to add that looking at it, Sam and I are obviously both members of the FPC. I think it's the second table, as you point out to, that has in some ways been more dynamic during the year in the sense that things have come out of the woodwork. They're on the scale of things, they're not as bigger issues as the stuff in the traffic light presentation. But they're things that we sort of have learnt more about over the last year, some of which we're still chasing down. I think Sam has mentioned the payments issue, the retail payments issue, and a lot of that sort of picks up a point Norska was making earlier, is to do with ensuring that customers, particularly in the EU, can still be serviced. So the payments one is a good one in case that obviously where they're making a payment back to the UK, they can. And I think it's fair to say we thought that had been mainly solved by about the autumn, and then we found that actually, while the main point had been solved in the sense that there was an agreement to let it happen, actually, when you're not in the EU, you have to add more detail into your payment instruction, and then we got the question of were the UK banks fully ready to do that, and the answer sort of goes back to what Sam was saying, is some were, some were not. And we're still chasing a few down, and we've got a bit of extra time, obviously, to get that sorted out. So the second table has been a bit more dynamic in that sense, in terms of, say, devil in the detail type stuff.
When you go to them and say, here is a problem, where it is one that is largely affecting the UK, are they still interested, or are they only interested in the things that might affect their end?
Well, somewhat to the point Norska made earlier, which is, in a way, we actually dealt with a lot of the UK issues quite early on by designing the temporary regime, which in a sense was designed to sort of allow a continuation of the current regime and sort of, in a sense, take it out on a glide path so that we could deal with it more smoothly. And that solved a lot of the issues in the UK. So that's why we've pointed out that more of the issues are in the EU, for the reason that Norska said, they haven't adopted the same approach. So that's why, actually, when you look at the balance of issues over the last 12 months, probably, more of them have been on the EU side than the UK side. Lord Cavendish.
Yes. Sticking with Brexit-related risks, could you give me a fairly broad brush feel of the risks, the other side of the coin, that both the EU and its institutions face as a result of Brexit, and the individual member states?
Well, perhaps I could begin. For each of the three main issues that I described, those I think could rebound just as much on the EU as they will on the UK. That's particularly true, I think, for the central counterparty issue, because I think if you sheared off that bit of financial plumbing, it could cause really quite a dramatic effect, which would affect all of us. It gets slightly more complicated when you get to things like the uncleared case, because another consideration comes into play for the EU, which is if they run a bit more of a risk on it, might they also have the effect of pulling a bit more business over into the EU? Now, I don't think that's something that features in my colleagues' thinking, but it does feature in, I think, other governments' thinking. And I think the clearest evidence for that is the difference that Andrew's just described, that here in the UK we did the temporary permissions regime because it removed financial stability risk. It also suited in terms of industrial policy, whereas that second part of the logic doesn't hold on the other side. So I think they will be quite at risk from those things I mentioned.
I mean, I would just add at a high level. I think if you look at one of the obviously the large initiatives that the European Union has had in the wake of the EU financial crisis, which obviously came a bit later, it's Capital Markets Union, and the reason for that I think is sensible, which is one of the things that crisis illustrated was an over-dependence on bank financing, particularly bank financing of the corporate sector, and a sensible desire to shift the balance towards a more developed capital market. Now, a certain amount of progress has been made on that front in the intervening period, but I think everybody involved recognises that there's quite a long way to go. And I think this goes to your question, I think the big issue is, for the EU is, well, do you want to develop Capital Markets Union in isolation from the largest European financial market or not? And if the answer is the second, which obviously we would say is a sensible thing to do, is to regard it as a European issue, then obviously you get back to the question of what the future relationship is going to be. And it seems to me that it's in their interests then, and in all of our interests, to enable that to happen with the involvement and support of markets and capacity in the UK.
Thank you.
And if I were to add to that, I think what our counterparts are really interested in is continued cooperation and being able to oversee our markets, our respective markets, which are quite interconnected. And as Andrew says, see at the Capital Markets Union the importance of open markets, which would benefit their own customers and their own investors. So I think the EU is mindful of that as well.
Thank you.
Lord Rhodes.
Thank you. Which areas is EU market access particularly important for the UK financial sector, and what sort of discussions have we had so far on equivalence in those areas?
Well, I'm going to start. I think it is important, actually, for the reason, going back to the previous question, in wholesale markets it is important, and generally the equivalence regime is probably more widespread in wholesale markets than it is in retail markets. So for the reason, say, we were just discussing in the answer to the last question, I think it is important in wholesale markets. I think in retail markets, and colleagues will want to come in on this, it is, of course, pretty patchy, actually, in terms of, the equivalence regime is often commented, is a patchwork. It's developed over time. It's somewhat different in each piece of EU legislation, and some of them don't have anything in them. There is no equivalence. Probably the most developed is the MiFID II equivalence regime, which is obviously the sort of big plank of wholesale markets. That may be because it's wholesale, it may be because it's actually probably the most recent to be done, and you can certainly, I think, if you look at the history, you can trace the evolution somewhat of the equivalence regimes over time as they've been more developed. So you've got this patchwork. I think it is, if you look at the sort of dependence on it, more important in the wholesale world, and then it is quite patchy in the retail world. But I think some of the issues we were discussing earlier illustrate why it's necessary. If you take payments, for instance, why for obvious reasons there are a lot more cross-border payments these days in the retail markets as well.
I agree with that. Perhaps I could just add a tiny bit of colour. I think you can come into the question two ways. One is what's happening at the moment in terms of what business, if you like, is being exported from the UK to the EU, and the other is, as Andrew was saying, which equivalence files touch on that question directly. On the first, very crudely, I think a way to think about it is if you take the ONS stats, we have 280 billion of output from our financial services sector. Our estimate is that roughly 30 billion of that is to EU clients, and maybe 50 billion or so is related to the EU in some quite close way. And within that, About half of it, just as Andrew says, is investment banking, wholesale banking of various kinds of really investment banking within that, and then the rest is split between asset management, insurance and infrastructure. So that immediately leads you to see where the focus might be. As it happens, the equivalence files take you in the same direction, because as Andrew was saying, the MiFID and MiFIR equivalence actually does provide significant market access for wholesale. If you come on to the other two files, which touch on my responsibilities, the banking files, CRR and CRD, actually don't confer market access. You get equivalence to that. It's not about market access. And for Solvency II and insurance, there's 3 different bits. 2 are nothing to do with market access, and 1, reinsurance, is indirectly to do with market access. So I think that takes the focus really, at its simplest, it takes it to investment banking.
And the steps that most investment banks have taken already to sort of offshore what needs to be offshore and all the rest of it, does that make a difference to the end result or not, in terms of being able to access those markets?
Well, in my opinion, it does. We've been very keen, from very soon after the referendum, to say to financial institutions, you need to be in a position where you're okay for no agreement whatsoever. And they've all acted on that, and as a result have established offices in the EU of various different kinds. So that does mean that they shouldn't be in a position where a chunk of their revenues just fall away from those groups in the event of no agreement. That doesn't mean that equivalence can have no effect. A, because it affects how much that revenue comes into the UK. And B, I do think that where the parties get to on equivalence will send a bit of a signal about what confidence banks and insurance companies and other types of financial institutions can have about running business across the border. How much confidence we can come to, but I think it's still relevant.
Very nice, Cruzy.
Where do you envisage the relationship between the EU and UK financial services ending up, particularly in the light of the Prime Minister's written statement where he said he would enhance provision for regulatory and supervisory cooperation arrangements, which sounds rather woolly. And where would you, a slightly different limb to that, where would you like it to be? Because it's slightly different from where you think it's going to end up.
Well, perhaps I'll start, but I think, I'm sure both of my colleagues, this is, of course, an absolutely central question of the day, as it were. So, clearly, we've said all along that we are very strong supporters of open markets, globally, not just regionally. So we want the arrangements to support that. Now, the question is, and your point goes directly to it, is what is the best way to do that, given the framework we have? So we have obviously an equivalence process that has been agreed to. We will go through that. I think, interestingly, the question there are really 2 questions in this equivalence process that we're going to. The first one, in many ways, ought to be the more straightforward one, which is, are we equivalent on day one? And the answer, it would be hard to imagine the answer isn't yes. And indeed, even our counterparts on the continent, Stephen Meyer, as head of ESMA, has said some of the things. Because the approach obviously has been to essentially copy out the rule book, but that doesn't really obviously answer the true question. Is a different one, which obviously thereafter, what is the scope for sensible divergence? And that is interestingly not a question that classically the equivalence process answers, because classically the equivalence process says take 2 regimes. So let's take the EU and the US as obviously case in point. They've grown up largely independently. There's some global standards sometimes obviously embedded in there, but they've grown up largely independently. Assess them against each other as to are they similar enough to essentially declare, you're confident to open markets in whatever way that's provided under equivalence. So they're answering a different question to the one our process is going to have to answer, which is you start pretty much the same, but what's the scope? And that's I think why. The thing that is being commented on a lot at the moment is key, which is what is going to be the framework to enable that to happen. Now, I don't think there's any question that ultimately the decisions are taken, obviously, by each jurisdiction. We don't pool decisions internationally in that sense. What we do create, and with due respect, the woolly piece that you said, is that we do create mechanisms to, A, have strong cooperation and coordination between whichever authorities are involved in it. And I would say, drawing on point Nozka made earlier, regulatory cooperation post the referendum has remained very strong, and we've deliberately, on both sides gone out. We have very strong relations with our continental counterparts, and we've been very keen to make sure those were not eroded. Secondly, I think you have to have mechanisms to say, okay, at the end of the day, we each take our decision, but the process by which we reach the assessment is not going to be done, on a separate planet, as it were. We do have, strong, effective coordination. We do want to understand what each other is doing. And I think the mechanisms that the Prime Minister and the Chancellor have been talking about are how I would imagine sensibly we would achieve that. And that's very important because history will tell us that there's plenty of scope otherwise for this not to work effectively. It's only back to 2012 when Sam and I remember the then European Commissioner for Financial Services was accusing us of seeking competitive advantage by imposing higher capital requirements on banks. Now, we think we thought that was a mistake at the time to conclude that. You would want to have a mechanism to say, okay, let's sit down and talk about what we're doing here, because we don't think we're doing that. We think we're doing sensible things. If that ended up in a sort of, a metaphorical punch-up every time and a threat to withdraw equivalence, that process just would not work properly.
Yeah, that's right. I was just going to add that these sorts of arrangements that Andrew described, we also have with other countries in the world as well. And we currently with Japan, the US, etc. We have these strong cooperative relationships, a sort of regulatory dialogue, where we can either have sort of set-piece discussions, but also constant discussion about areas of common interest, whether it's fintech, whether it's supervising connected markets, whether it's sharing information or data. So we definitely want to get to that position with the EU, which is our closest neighbour as well, and continue that kind of cooperation that we have. I would just say on the other point on equivalence that Andrew mentioned, that the Commission itself has explained that the equivalence process is risk-based, proportionate and outcomes focused. And so there's been a lot of discussion about whether our rules will be aligned, whether we follow rules, etc. But actually the framework of the equivalence process is not that. As Andrew said, there are different countries have different rules and have equivalence arrangements. So within that framework, it's possible for each jurisdiction's regimes to evolve, but yet still deliver the same substantive outcomes.
So from that, are you confident that if we do diverge in areas, say, like building societies, which are pretty unique to the UK, or annuity pensions, or there's various areas where there would be very good reasons for us to have domestic divergence, and we may on some things which actually cross over in sort of international types of areas of business for good, sound reasons. Are you saying that you think the mechanisms are there then to have the dialogue so that we don't lose the equivalence? And if you do you think that there is a danger for various either political or protectionist reasons, should they come to the fore, that Europe will withdraw equivalence in perhaps what is not necessarily entirely logical
Well,
way?
can we, I think someone wants to come on this, but it's interesting to unpick that, because I think you go right to the point about what are the circumstances in which we would want to, in a sense, to move apart somewhat. And I can see three things there. One, clearly both of us are going to have to review our rule books, because we do, because the world moves on. And also, let's be honest, we don't land everything perfectly first time. I mean, it would be a pretty bizarre world if we did that. Secondly, there are bits of European legislation that just don't work particularly well for the UK. You referred to the annuities. I'm world expert sitting next to me on this subject. I retired from that subject. Sadly, I'm being dragged back into it. And thirdly, I mean, you referred to building societies, so that's another interesting one, because that's a case of, what about firms that do not actually do international business? The Basel regime actually only applies to internationally active banks. So the question is, are you going to have the same regime across the board or not? But that's
I'd say
a speciality.
We may come on to specific areas, but logically and in the way that the framework is described, the equivalence framework or frameworks more properly stated, it ought certainly to be the case that there's an ability to manage divergence. And if you look across the 240 or so equivalence decisions that have taken place, they manifestly cover regimes which are very different. And yeah, for instance, that's true on the Solvency II side in terms of the difference between the US regime and the EU regime. So that ought to be the case. Whether it will be the case, I honestly don't think we know. We want it to be the case, and it should be. We don't know. Perhaps I could just add very briefly one other point, which is I do think it's helpful to distinguish here between regulatory cooperation, i.e. about rulemaking, and supervisory cooperation, what we're doing with firms. On the latter, I have a very high confidence it will be absolutely fine. And the reason I say that is that there's a very strong norm established with colleagues in the EU, but also in other jurisdictions about the way that works. None of that needs the special European infrastructure. It happens in colleges, it happens bilaterally, it happens every day. As a sort of precaution, we've signed MOUs now with 23 out of the 27 national competent authorities. We've been doing that together to kind of cover that. But basically, if you've got that, you're good. So I think that side will be fine. The more tricky area is this regulatory one we've been touching on.
Sorry.
Yep, go ahead.
Could I ask what lessons, if any, of course, have been learned or are to be learned from the Swiss example?
Well, if you had the Swiss here, you'd have a speech of some interest. They give it publicly, so I'm not blowing any confidences. I mean, I think it's been pretty difficult in a sense because, first of all, I mean, obviously the origin of the issue in the Swiss case is actually not to do with financial services. So one of the painful lessons of that is that you can find yourself brought into an issue which is not originating in your own area of activity. Secondly, obviously, it then led to a quite abrupt withdrawal of equivalence and consequences for that. I mean, because ironically, and certainly if you take the equity market, the result was that all the equity trading went back to Switzerland. But I think, certainly I can tell you, I think we've all talked to the Swiss at some length about this. I mean, it was quite a difficult experience.
I think the abrupt point is an important one. So obviously there was a bit of debate in public yesterday about this question of permanence. But the government's objective, as I understand it from what the Chancellor's put in the newspaper, is to try and achieve a greater durability of some kind around equivalence. And it is obviously the case that if it can be withdrawn with 30 days' notice, that firms are going to be quite reluctant to put much weight on it. So I do hope that it will be possible to agree something more durable, but whether that will be the case in the negotiation is hard to say.
Here about there may be political reasons or fear of competitive advantage, which would mean that the EU would withdraw equivalence because it's political with Switzerland largely. But we're a bigger financial services sector, and which would have a bigger impact on Europe if they treated us in the way they treated Switzerland. So do you think that is something to be seriously concerned about, or do you think the mere size of our financial services industry would mitigate some of the more draconian measures that they might be able to take if they chose to?
Well, my view is it is something that we should be concerned about because plainly I think it could occur. But I think you're never going to remove that from this system. I just don't think it's realistic to expect that. What I think may be possible may be to make it less of a problem by making phase-out periods longer, because I think firms would rely on equivalence to some extent if they thought they would have time to rearrange themselves if it was withdrawn for a political reason. So I really think it's the combination of the abruptness, as Andrew said, and that factor which makes it less valuable than it would otherwise be.
I think they're talking about 2 years, aren't they? A change to 2 years, I think.
Well, so the Commission and the EU side has said nothing. The government, I think, is yet, as far as I know, to say something public. But certainly 2 or 3 years is a normal kind of an off-ramp for something like this.
Sorry, I kept interrupting
Well,
you.
no, it's okay. I was just going to explain from the experience that we have so far with the way that the Commission has operated this. I mean, in Switzerland's case, actually the equivalence arrangement was actually temporary, so there was a time limit on it. So yes, it was abrupt, but everybody knew that it was that time limit, so it didn't suddenly arise in 30 days. The other point There's been one other case in which the EU has withdrawn equivalence, which is on credit rating agencies for Australia, New Zealand, etc. But in that case as well, the Commission has made clear that there was a long dialogue before that occurred. So I think we can, we don't know what the future holds, but we can draw some conclusions from the way that it has already operated, that actually there is some dialogue and there's some notice.
Although I would emphasise this point, and I think it's particularly difficult with the Swiss case, as I say, it was bringing financial services into an argument that was going on in another part of the landscape.
Yeah.
Which of course is not entirely possible. Well, this time fish, for example. Lord Desai.
Are we still on question 4?
We are still at question 4.
Okay. I guess it's sort of the opposite of it. What are the risks of really very close alignment? Because yesterday's headline in the FT was we're about to sign up to complete close embrace forever and ever. Are there risks to the UK position globally of aligning too closely?
Well, perhaps I could begin. I think there's two risks, one of which is directly relevant for us in the bank, the other which is not, I think, so relevant for us, but may be relevant for you. The one that's relevant to us is that we don't think that we can have confidence about our mandate of maintaining financial stability if we have no say over the rules, given the size of the financial sector we have and given the fact that it's very different from what there is in most of the rest of the EU. And there are numerous examples of things which either don't work perfectly but we're able to fix, or which could become a problem. And just to illustrate the point for you, something called CRD5 will land in this country, I think, on the 29th of December. And our team has had to work strenuously to make sure that, as an accidental byproduct of that, it didn't become impossible for us to capitalise our ring-fence banks to the extent we want to, which was just something that we'd done and hadn't been done in the rest of the EU, a major plank of our reforms. And there was a very real possibility. Indeed, without the intervention of our teams, I think that would have been frustrated. So it just gives you a sense of the sort of thing that could happen if we just blindly aligned. That's the bit that's, I think, relevant to the Bank of England and probably regulators more broadly. The other piece, I think, is less for us, but maybe just worth mentioning, which is I think there is an industrial policy question, given the objective that our government has to have a large global trading centre here, and given the quite openly stated and perfectly respectable objective that some other governments have to move some of that into their jurisdictions. I think there is a question as to whether it is sensible to sign up to rules set by those other jurisdictions with that in the background.
I understand. I think there are 2 points for me here. One, going back to something we were just mentioning a few minutes ago, I think it is absolutely essential that we have the capacity to review and adapt the rule book, because clearly, as I said, the world moves on, and clearly, frankly, we find some things work better than others, and I think to find that was constrained would be very difficult. The second thing is a little harder, and I don't want us to come across as seeming arrogant at this point. I mean, it is of course the case that the rule book we have today, that has come out of the EU, has obviously been developed with a very large amount of input from the UK. And I've been involved in it for over 30 years. I mean, I've always taken the view that successive UK governments of whatever party have rationally taken the view, if this is going to affect us and we've got the biggest financial markets, we should sort of get in there and influence it. And I think we've been pretty successful over the years. I think you can point to things that we don't like, but actually there's a lot of other things that either we wanted or we wanted to limit the damage, where we've been pretty successful. Now, of course, we're going to move into a world where that's not going to be the case. So, counterfactually, what the future will look like in the absence of that is obviously hard to judge, but it's clearly a risk if we were to be locked in, to your question, very tightly.
Are we up against some elementary psychology that people fuss more about losing something they've already got than foregoing something that they haven't already got? So we start off, we might have 100% overlap with the EU. Let's say the US or something is 80%, but it's deemed to be equivalent. And yet they fuss about moving a small amount from where we are now, a lot more than the fact that there's still a much bigger gap that they're tolerating with someone else, because it's they're not giving up something that they already have. And my worry is that they will get obsessed by some small change we will make, which is already being tolerated with agreements they've got elsewhere in the world.
Well, I think you're right to point to that. Just two thoughts on that. First of all, we don't know, of course, but you're right to point to the potential for this to happen. And I think that's why, it is right to want to have this sort of, the surrounding mechanism, as it were, to ensure that these sort of decisions are taken sensibly. That at the end of the day, each of us takes our own decisions, but they're taken sensibly to limit the risk that you rightly point to. I think the second thing, which is also, I think, very hard to judge, is that, of course, there have been, noises made from the European Union that they will treat us differently on a sort of what you might call a sort of slightly reverse proportionality argument, that because we're near and big, we're going to be held to a different standard to anybody else. And again, we don't know what that adds up to in practice, but I think it's another reason to be, to be alert and sensitive to the point you raise.
I would just add a further point, which is a sort of more contextual one, which is obviously we and the EU will continue to influence global standards. So we do operate in a global context, and a lot of the standards in domestic rules and in the EU are actually sort of formed at an international level. And so there are lots of examples of that, particularly in financial stability, insurance, even cyber resilience. There are a lot of issues that we discuss at a global level, which then cascade down into domestic and European rulemaking. And we'll still be at the table on those, and we'll continue to be influencing that. So I just thought it's an important contextual point.
But that does raise an issue which is sort of more in Sam's world, really, but which is looking at it from us to them, as it were. If, as is the case, they don't implement the Basel Accords properly, what do we do about it in terms of the equivalence judgment we have to make?
Yeah, I mean, it's an interesting example of that, which will come up in June of next year. It sounds rather small and techie, but I think it's quite important. So one deviation that the EU is proposing from the latest Basel deal is to allow banks to count as capital their investment in their own IT systems. We've always been very cautious about that idea because we've had numerous blow-ups where IT systems haven't worked, and also the idea that when a bank hits the wall, it'll be able to monetize. Seems so highly dubious. Now, but we, to be fair, we lost that argument in the EU 28 setting. I mean, our leverage has been greatly reduced, of course. But there'll be a question for us, which we haven't made a decision on, but a question for us when that comes in the middle of next year. Do we join the EU in being non-compliant with Basel and allowing in this thing, which I don't think is a terribly good idea, or do we hold the line?
I'd like to turn to opportunities, because we've had a good discussion on risks. Where are the opportunities for the UK to diverge from future euros? You, Mr. Bailey, sort of championed the sandbox, and of course the world is changing with the huge digital revolution. And I'm obviously concerned that we could be held in a straitjacket and not able to look forward to the future adequately. And I'm also concerned that UK businesses and UK banks, I sit on a small one, should actually get the chance to move forward in this new global vision that you've described so well.
Well, that's very interesting. I know we've discussed it before. I mean, it's interesting in looking back at the last 2 years. I mean, there's no doubt that when we look at our sort of, our partnerships around the world in the area of fintech and the sandbox, and we at the FCA have created something called the GFIN, the Global Financial Network, which is based around IOSCO, really, which is our equivalent to the Basel Committee in many ways. Yeah. It is interesting that, certainly the early and stronger relationships were outside the European Union. The European Union has been rather suspicious of it. And I keep hearing sort of slightly suspicious arguments that this is sort of, slightly sort of going beyond the rule book, which I don't think it is actually. I mean, I hope that's, I think there are signs that's changing, and I hope it is. But I think, to your question, I think what that illustrates is that, we've got a global market. We have developed very strong relations in that area with other countries. We want to go on doing that and develop them. And that is certainly, I think, one of the opportunities we have, frankly, and we should take that opportunity.
I would pick out two examples for you. One is on the insurance side, and I remember vividly Lord Turnbull describing Solvency II as an absolutely dreadful piece of legislation, which I do think was a little harsh. But there are bits of it. There are bits of it which don't work well, and in particular, there's a thing called the risk margin, which is a great example of an unintended consequence that it was designed in one environment, and now we found ourselves in a very low rates environment. And for UK firms writing long-term annuity business, the effect of that risk margin is not what was intended, which was that insurers should hold a bit of extra margin in their liabilities. It's that they're offshoring longevity in huge volumes. It's very unhelpful. So we will, I think, want to change that. There is a discussion going on in Europe in the Solvency II review as we sit here about whether or not to change that, but of course we're not in the room. But that's one opportunity, I think, an important one. The other one, maybe more interesting, given what you said in your question, is we are very keen on the idea of a simpler, not a weaker, but a simpler regime for small firms and particularly small banks. I believe, and my colleagues believe, that would be a good thing, both from a safety and soundness and from a competition and from a competitiveness perspective. We'd like to work such a thing up. It's very difficult to get such a thing agreed in an EU 28 setting because one person's big is another person's small and things of that kind. And also for the difference that Andrew described. But I think that's something that we would like to do, and our opinion is that such a thing could be done, for instance, it's relevant to your building society's question, it has no relevance to equivalence whatsoever. Whether that proves to be true or not, we will have to find out.
I think it's interesting that for me the problem with Solvency II, and actually why it works better in general insurance than life insurance, is that it presumes a single market in life insurance products in the European Union. And actually, as Sam said, it's still a series of national markets essentially, and that's why I think it has not been easy to make it work in that market.
Lord Turnbull, did you want to?
Well, one of the reasons I say it was a dreadful piece of legislation is that it not only impeded a particular market, it actually frustrated certain government policies. So trying to get banks to invest in long-term infrastructure, and the way the risk margins were and the risk weightings were decided made that more difficult. And anyway, the more general question is, over the years, we have managed to been quite successful in moulding financial legislation in ways that are suitable to us. But sometimes we lost the argument, and Solvency II, I'd say, was one of them. But we went along with it because we didn't have any opportunity. But we were kind of slightly resentful about it. And we think, well, now we can do the things that we really wanted to do. Are there any others other than the two you've mentioned that you would put into that category?
Well, there's a more structural thing, which we refer to sometimes as the style of regulation, and I think actually is, as it happens, exemplified by Solvency II. So we have floated a proposal that, if you look at the way that financial regulation has been done for the last 20 years in this country, which members of the committee will understand some of this better than I do, FSMA 2000 essentially set the objectives for the FSA, and then the FSA made all of the rules. If you wind forward to the latest version of EU 28 rulemaking, of which Solvency II is a great example, MiFID would be another, you have a huge volume of detail up in legislation, including some really very complicated algebra and actuarial tables and things of that kind in Solvency II. In between those two sort of bookends, if you like, are the way that we've done things in the UK since. And I think the senior managers regime is an interesting one, where important things were put into the law, but then a certain amount of detail was left down to the regulators. And I do think there's an opportunity, and indeed it would be sensible for Britain, once it's exited the EU, to move back to that more British style of regulation and have more of the regulation done down in the rulemaking of the regulators. There's an accountability question which we may come on to alongside that. But I think such a move is a rare win-win, because it would, I think, be good for safety and soundness and financial stability, because we'd be able to adapt to things as they go along. But it would also, I think, be good for competition and competitiveness for the similar sort of reasons. So that's a more a structural point, but from our point of view, it would be very desirable and I think sensible to move in that direction.
And the only point I'd add to that is that I agree with Sam, it is a British style. I actually think it's also, the reason it's that is that it's a style that's associated with common law systems, as opposed to civil code systems, which tend to embed more of the rulemaking in the legislation. So, there is this sort of fundamental difference. Now, over the years, of course, we've had to essentially adapt to that world, but we, in a sense, we now go back to that question again, as to Sam rightly puts it. What is the sensible way to do it in a common law regime?
If I could
Yeah,
trench up.
Can I ask another supplementary to that? You've mentioned Solvency II and bits of MiFID II where we were outmanoeuvred and we might not have adopted exactly the same regulation as it was. But another one, which hasn't been mentioned, is AIFMD. In other words, the whole alternative fund management regime, which was largely, almost entirely the UK's, and indeed it was relatively recent that the Commission decided to legislate in this area. And it was not expected when the Commission did move into it, and it has certainly not been in the interests of smaller asset management companies. It has definitely cost London and other, like the Crown dependencies, also business. Do you think that there are therefore opportunities to be gained by diverging or maybe abolishing the entire alternative fund management regime, because most of the investors in it are high net worth or professional or institutional, and they don't need the protections that AIFMD purports to give them. And it's bureaucratic, it's expensive, it's cost jobs. Bits of MiFID II have resulted in mergers and decimation in the number of analysts covering smaller companies, which reduces choice for investors. So could you say a little bit more about which opportunities to diverge there might be? And then there's the difficult question of the timing, because if you don't say anything and December the 31st comes and we're wholly aligned, we can claim equivalence. But if they know that on day one we're going to seek to diverge in this area, this area, this area, or they suspect it, therefore it's going to encourage them not to grant full equivalence from the beginning. But you hear often many government ministers have said, but it's easy to get equivalence because on day one we're going to be equivalent. Yeah. But if we already know that we want to diverge on day one, it seems to me we're more likely to get a framework that's going to be durable by being honest about it up front.
Well, let me start off, and I think Oscar may want to come in on this. I think that's why earlier on I set out the two parts to the question, and how the second part was actually, in a sense, the much more important part, which is, as you rightly say, not are we equivalent yet. The answer to the question, are we equivalent at day one, ought to follow reasonably easily. There'll no doubt be a load of work involved, but I don't think the question is hard to answer. But the real question is, as you say, is what happens thereafter. Now, I think there's an interesting question then as to, do we say now, well, we don't like the following things, or do we say, look, just as the EU will do, we will have a process by which we will, review, big parts of the stock legislation, because the EU is going to review MiFID. And we've said it's going to review MiFID. It's going to review PRIPS, which is another, malfunctioning piece of regulation, and we will do the same. And what I want to do, I think we have the real issue here. Do we sort of run the flag up the pole and say, here's the following things that we're going to sort of go for, or do we say, look, you've got to accept, and this is why we need a sort of a structure around it, that there will be a review process. You'll do reviews, we'll do reviews. That will be the normal course of events. And we'll, and in doing that, we will, expose the question: is AIFMD fit for purpose? And if not, what do we do about it? And I would rather see us set up a structure in which those questions can be answered, and it's understood that that's how we do business, because it is how we do business. Actually.
And we also, in doing that review, consider also the costs that industry have already outlaid to implement rules, and so you do a usual sort of cost benefit in how we review different aspects of our respective regimes. I was just going to add on the previous discussion we were having that we also at the FCA have some instances where areas that have been onshored into our own rule book and our own legislative framework may not work so well, in the sense that, for example, we've got detailed PRIPS rules up in legislation equivalent to primary legislation. So we will need, after exit, to have a look and think about, well, where should all this settle? Is that something for Parliament, or is that something for the regulators? But also we've said that we're going to look at our regime as a whole and look at whether or not our regulatory rules, etc., are fit for the future. So we're looking at future regulation. Should we be going to a more sort of principle-based, outcomes-based approach? I think Baroness Neville-Roth talked about fintech agenda and the digitalisation of the industry. So we really need to think hard about whether the frameworks that we have in place work in that context. And I know from my own experience with cyber resilience that a lot of the rules and the requirements are actually quite high level, and that's a good thing, because if we start to draft very detailed rules, they'll be out of date by the time the ink is dry. So there are things that we need to be considering going forward, and as Andrew says, we will be developing our regime just as the EU will be developing its. It won't be static. So it's good to have that acknowledgement at the outset.
Okay. Lord Cavendish.
Yes, I think some of this question has been touched on, but not all. Can I ask, how might the UK take a different approach to financial regulation after leaving the EU, such as giving greater discretion to regulators, and specifically, how would this compare to other jurisdictions beyond the EU? And how would the hybrid approach we hear about work in practice?
A bit of colour on the comparison with other jurisdictions beyond the EU, because I think my response to your first question is the one that I just gave.
Yeah.
If you look across jurisdictions, you can do two comparisons. One is you pick something in our world, which is the Basel III reforms, the main banking reforms following the crisis. In every single Basel jurisdiction in the world, apart from the EU and Switzerland, all of that was done through regulators' rules. It is only in the EU and Switzerland that gets drawn up into legislation, and I think the main reason for that is a perfectly respectable one in the context of the EU, which is to make sure that everybody does it in exactly the same way. But if you have left, that no longer binds, and I think the question naturally arises. So that's one comparison you can do. The other way of looking at it is, if you look across different jurisdictions, what are the rulemaking powers of regulators? And perhaps we may come on to this, what is the ability of government and parliament to intervene directly in that process? And what you see is, if you map that out, that in nearly all jurisdictions, people who do our sort of job have a rulemaking power like we have. Slight quirk in Canada, where formally it's not binding, but they have another power that can make it binding. So I think you consider that the same. One exception, interestingly, is France. And then if you look at the ability of government or parliament to intervene in and change those rules, which gets to the question of what's the balance of operational independence versus accountability, that is a pretty mixed picture, actually. You have some jurisdictions like our own where that's not the case, although of course there's a lot of examination of regulators in the way that we're doing today. Others where there is a more direct role. The US is an interesting one, and I'll just finish on this, where the way it works over there crudely is that Congress does not have the ability to get in and change the rules, but it does have a sort of backstop ability. If the regulators make rules, within 60 days, if Congress can pass a resolution which is also signed by the President, then they can, in effect, veto that. So that's a sort of backstop, if you like. It's hardly ever been used. It was only used, as far as I know, in recent times anyway, in the early days of the Trump administration. But that's just an example of a different kind of a model.
Thank you. Thank you.
Yes.
It's really a follow-up to the prior question as well. What I'm concerned about, if the rules go to the regulators, which seems quite sensible because you're very professional, you'll consult, is that your direction of travel is going to look after, the consumers, the small banks as well as the big banks, and try to sort of cut down the bureaucracy, which I have to say, as somebody who's involved in financial services, lots of different areas, is very burdensome. So you've got a lot of cost within the economy going in, as well as obviously this terrific contribution to GDP. So my question is, how in this new world, if you're to take over more of this regulation, how can we be sure that, as it were, the spirit of the regulatory sandbox will rule okay, rather than always thinking about supervision and therefore having treble checks on everything? In this committee, we talk about innovation and moving forward, and is this an opportunity? And that's a supplementary on that point.
I think there's an interesting question here about obviously the future direction of what I might call the sort of the broad oversight. I mean, I would say at the moment, but because a lot of this has been driven by the fact that a lot of the rulemaking is sort of originated in the EU, that the oversight is more in the direction of what I would call accountability than scrutiny, in the sense of sort of looking backwards rather than scrutinising what's looking forwards. And I know you've had other hearings on this subject with other witnesses, and I think there's an interesting question there as to, sort of goes to Sam's point, which is what is the sort of sense of, it makes sense not to legislate at that level of detail, it seems to me, but then the question becomes what's the sort of appropriate level of scrutiny? And that's a question I think that broadly hasn't been answered, because the EU has, in a sense, occupied that space so extensively in the past.
And it's worth reflecting why the EU has done that, because obviously it relies on national supervisors to implement rules, and it doesn't have as much control perhaps over of whether or not the rules are applied consistently. So it needs that control of the rule-making process in more detail to ensure the sort of consistency across EU 27. But obviously that's not the position for us when we leave the EU.
Yeah. Lord Bruce, do you want to take up the issue?
Well, just following that up, I mean, what is, in your view, the role of Parliament in all this? Because we, as you say, the EU have been doing the rules, and the EU Parliament has had a very substantial role. But as you, Mr. Bailey, have said, there's a kind of cultural difference of approach, for good reasons, but nevertheless, freed from that, we're going to be more outcomes-based, more pragmatic, more flexible. So we don't necessarily need all that, but on the other hand, Parliament is going to face a rapidly changing situation with restructuring of our committees and really not very much clarity of whether we can monitor what's going on effectively, and indeed whether we'll have the resources to do it on the scale that's necessary. And just as a sort of minor point, whether we need to keep ourselves more connected to what's going on in the European Parliament or not, whether that matters or not. But I mean, how do you envisage Parliament monitoring this, and how well resourced will we need to be actually be competent at it?
Well, it's a very interesting question, because there are answers to that question which would require you committing vast amounts of time to scrutinising at a very low level of detail, which, I mean, it's not for me to presume what you want to do. But, but you see,
I
the
don't
European
think parliamentarians want to do that. I think what we need to know is what's going on. Is it doing the right things? What's it going to mean for the wider economy? We wish just what is happening.
I just going back to Viscount Trenchard's point. You see, I think I hesitate to give advice on this, but I would do, as I say, I think there does need to be a shift of the sort of emphasis towards more asking the question, before, let's take IF&D as a cause célèbre, before it is done, and then the sort of, it becomes ex post. Of ensuring that the processes we do consult. I mean, we have an industry of consultation. I read them all, and I can tell you, it was a commitment I made when I went to the SCA, and occasionally I've wondered whether my evenings could be spent doing other things. But I think the question is how we can sort of help to design an efficient process which allows scrutiny at that point, but doesn't swamp you, frankly, which would be easy to do and counterproductive.
Yeah, if I might add, there's a thing that Andrew and I have been discussing, which is, so at the moment we both produce a business plan which says everything that we're going to do, and people could take interest in that if they wanted to. But I think what we're talking here about is a possible change in the way we're doing rulemaking specifically. And I had a look back at our own business plan in that context, and it was apparent to me that it might not serve the purpose that you described. So my suggestion would be that if we do end up moving in this direction. I do think a contribution that we can make, and obviously it's for you to decide how you want to do the accountability and committees and all that, but there is probably a thing we could do which would be to signpost much more directly and clearly and directly to the relevant committee or committees in Parliament. Here is our forward work programme for the next 12 months. Here's all the rules we expect to be making. You, of course, may summon us on any of them to ask us what we're doing, but we could highlight, we say these two are kind of pretty significant. We're setting up a new framework, or it's a big change from what it's for. These are more procedural. And at the moment, we don't have that, and that would be relatively easy to achieve, and I think would help you in your task.
Just to give you, I think it also needs to, we need to help the process to focus at quite an appropriately pointed way, because I just want to sort of pick up a point Viscount Trenchard made quite rightly about AFMD. You made the point, well, look, really, this is a regime that applies to sort of people who should be able to take care of themselves. And it's interesting, possibly not so much with AFMD, but with asset management more generally. I mean, the evolution of asset management, I would say, in the last, excuse me, in the last 10 to 20 years with changes in the pension system, is that far more of the population is now, using the asset management industry as the vehicle for long-term saving than was the case in the past. As going back briefly to Solvency II, as the sort of traditional life insurance industry is actually declining. So the challenge for us as regulators is, we've seen this, we've seen it with some quite obviously celebrated cases, and one in particular in the last year. Where do we draw that line? And I think those are the sorts of issues that we really need to try to, when we're doing this sort of scrutiny, we really need to try and get the focus rightly onto those sorts of issues. I entirely take the point you're making. So it come back, it's not an easy line to draw.
Sorry, just the point I was making is that the change from the detailed work that the European Parliament does
Yes.
to what's going to happen here. I mean, we've seen that the European Parliament is able to commission reports, is able to sort of bring in all kinds of expertise. Do you think that Parliament needs to have some capacity to do that, or would that be regarded as intrusive from your point of view?
Well, look, my view is that if we end up moving from the mode we're in currently, where exceptionally when we do a piece of UK-only legislation like senior managers regime, we do it in us doing a lot more of the work, but most of the bulk of what's coming through is in the European model. I think if we move to the former, to me it's entirely natural that Parliament would have a bigger role in examining what we're up to, and I think that's totally natural. I think the difficult question is, which in the end is for all of you in Parliament to decide, do you want though to remain in an examination mode, or do you want to be in an intervention mode where you actually have the ability to intervene in the rules? And that I think is more sensitive because this principle of operational independence, not goal independence, but operational independence, is I think quite important, and is also very important, for instance, in the Basel context. So that's where I think the tricky judgment lies, not in the basic idea that if we're doing more of the rulemaking, more of that will be scrutinised in here or the other house.
Well, if things go wrong, there will be intervention, so...
Lord Thomas.
Could I move back to the area of global cooperation and the opportunities we have globally? Because quite naturally we've tended to focus on the EU and forget the wider world. And what I really first of all wanted to ask you is, what opportunities do you see of taking advantage of global opportunities?
In terms of development of markets or regulation?
Development of markets, the way we work with other regulators. And I want to come back to supervision in a moment and exchange of data, but if we could just take that very general picture first.
Well, I would say substantial. I mean, I think, again, going back to Baroness Neville-Ross' questions, I mean, I think we've seen very substantial development of fintech cooperation globally, and we're very, very strong supporters of that. I think it's something that is it's pleasantly surprised us, frankly, and it's going well. So I see that as a very clear thing. I think, let's face it, you look at the balance of growth in the world economy, it has shifted decisively, obviously, over time, makes it more important. London is UK is a financial centre that supports global activity. It's not just a European financial centre. And it's important to bear that in mind and to align ourselves to develop that, which is why, about things that Norsca and Sam were saying, we're very clear. I mean, I arrived at the SCA a week after the referendum, which wasn't accidental. And one of the first things we said was it is absolutely critical that we don't become isolated, and it's absolutely critical that we engage globally. And we've set out to do, both of us have set out to do that.
Yes, I mean, we invest heavily upstream on the prudential side, both in Basel and in the IIS, which is the insurance version of Basel. And actually, I'm very sorry our colleague, Dr. Supporter, for reasons of bereavement, couldn't join us today. She's actually chair of the IIS. And I think that's where, on the prudential side, the opportunities are for us going forward. In Basel, the main one I have an eye to is this operational resilience agenda, which we've been trying to lead on here in the UK, and there's a consultation paper coming out, hopefully at the end of this month, from Basel, which will have a strong kind of UK imprint on it. And this is joint work, I should say, with Andrew's team. And on the insurance side, there's actually quite a big milestone occurred in November, which is this IIS agreed under Dr. Sporter's chair to establish and test a capital standard, international capital standard for insurance companies, a bit like what we've got for Basel. Mm-hmm. And I think it's been very, very difficult to achieve that agreement. And I think our priority on that side will be trying to make sure that that kind of holds so that we can develop something like that.
And from the FCA's perspective, we engage in the multilateral fora, so the FSB, IOSCO. The FCA is the UK representative on IOSCO, an international body. So we engage very heavily on the multilateral global standard setting work and covering areas that Sam has mentioned, such as operational resilience, cyber, fintech, non-bank finance risks, and fintech, but we also have we also engage in a lot of dialogues bilaterally with other countries. So, for example, with Japan, we've talked about green finance, cooperation, fintech. With the US, we've done a lot of work in Brexit preparation, but we've also signed up to a fintech partnership. And of course, with China, there's been economic and financial dialogues on Stock Connect, etc. So we're already engaged in these, and we envisage continuing to be as well.
To what extent do you think what Ms. Berry's described as our common law approach marries more closely with an international view, bearing in mind so many of the major financial centres have that base? Does this help us?
Well, I have to defer and say I'm not a lawyer.
I know.
I know, it's blindingly obvious. But I mean, I do start with the observation that it doesn't seem to me to be a random outcome that wholesale financial markets tend to be present in common law regimes. I don't think that is a coincidence. No. I think they more naturally, they find it a more natural environment to operate in. I think it's something that can be adapted more rapidly. I mean, you know much better than I do. You get the opposite argument, which is, well, you can become too sort of slightly hooked on case law that turns up out of who knows where. But I think history tells us that is, that's not a random outcome. And I think much of the discussion we've been having over the last part of the most recent part of this hearing, I think really goes to that, which is where are the boundaries between what's in legislation and what emerges out of either case law or regulators' rule books which reflect that. And I think in a sense we've got to sort of re-find where we want to position ourselves there, because obviously over the period of our membership of the European Union we've essentially had to adapt our approach to reflect the fact that we were in a union which predominantly wasn't a common law system.
Mm-hmm. And in connection with that, in enforcing standards, are you able to say a little bit, you touched on the College of Regulators a little earlier, and to what extent is that area developed and will enable us, bearing in mind the nature of global markets, to continue the detailed supervision that is necessary for financial stability and other areas?
So, look, it's extremely well developed with some of our main partners. So I'd mention in particular the US, the federal agencies there, to a much lesser extent the state agencies, and Switzerland. But we also have arrangements of these kinds with lots of other jurisdictions. Indeed, it's a precondition of us allowing people to have big branches here in the UK. All of that works very well, and in fact, it works at least as well with, say, the US and Switzerland as it does with our European colleagues. So I think we're in good shape on all that, and I'm not really worried about it. I think the more difficult issues are about does our role in regulation change as we leave the EU on the international stage. I have to say, though, on that topic so far, I mean, it may be that we don't see ourselves clearly, but it really is not at all apparent to me that our status or influence in those international fora has been much affected by what is going on. But I think that's because those are technical gatherings, and I mean, bluntly, if you make the effort, you do the work, you bring convincing analysis, you can often make progress.
Thank you.
Baker and Trenchard.
Thank you. The balance between maintaining the competitiveness of markets and protecting the user or consumer of those markets has a very long history and goes back to the Financial Services and Markets Act 1999, when there was long debate as to whether competitiveness should be an objective equivalent to the other objectives, or should be a secondary objective. I think at present you have an existing objective of promoting competition, which seems to me to mean the same thing as having a competitiveness objective. I'm not quite sure what the difference is, but perhaps you could explain how you see this conflict, and how do you think we should find the right balance?
Well, we have different. We both have competition objectives, but they are different. So we should probably explain both of them. We can start with the FCA's competition objective, because the FCA's competition is actually a primary objective, whereas I know yours is slightly different. It is. I mean, precisely, it is competition in the interest of consumers. That's important. Now, we think that it's, if we can achieve that, we're providing a sort of platform for firms to be competitive. I think that's a view we hold to very strongly. There are different views on this. I mean, I recognise that because, as you suggested, I mean, the word competitive can be interpreted in different ways, and obviously, sometimes it's interpreted as internationally competitive, sometimes it's interpreted as domestically competitive, and sometimes both. I would also just note that in the current regime, both of us receive, as well as having, in a sense, the objectives that Parliament has given us, we both receive from the government, at least once during the lifetime of a Parliament, what is sometimes called a remit letter, although I think that's probably technically wrong. But it essentially sets out what the government's objectives are and what the government's policies are. And the government, I mean, the ones that we are both operating under, I think, at the moment, have pretty similar language in them about London as a financial centre, the UK as a financial centre, and the importance the government places on that and on developing it and encouraging it. And that feeds through into our approach. So I would say, from our point of view, it's a combination of having a primary competition objective and then having this letter from the government, which says what the government wants to see happen.
So look, I agree with all of that. I've always been a little bit cautious on this topic, mainly for two reasons. The first is that I think the history of the FSA's competitiveness objective is not an entirely happy one, and certainly my colleagues who work there do believe that that's part of what came undone in that organisation. Now, of course, they may be wrong, and others who disagree with that. But I think what that gets to is that it's sometimes understood to just mean a kind of proxy for or a route to weak regulation, which I think is a great mistake in the sense that our job is often more like a referee job, and as a referee, actually, you want someone who is an organisation that is reasonably, I think, firm, and I think that's part of what attracts money into the UK and particularly into the city. That's one piece of caution. My other caution is just about complexity, in the sense that financial regulation is a sort of moderately complicated field, and I think it helps us in that we've got a very clear objective: safety and soundness, policyholder protection, and competition as a secondary. And the more you add to that, the more I think you risk diluting the effectiveness of the regulator. And actually, I know you had witnesses here from the IRSG, and they wrote a report on this. And I think in a way their report exemplifies it, because they make exactly that point, which I agree with, but they then suggest we should have a competitiveness objective. They then go on to say, what about an objective for promoting climate technologies or promoting intergenerational justice? And to me, it just illustrates, I think, if you like a Christmas tree, if you load us up with these things, there is a risk. I say it's not a known fact or a certainty by any means, but just a risk that you dilute effectiveness a little bit.
From the FCA's perspective, just on, Andrew talked about our objective competition in the interests of consumers. That's why we've done a lot of work on market studies, financial innovation. Innovate came out of actually the competition remit that we already have, which is to enhance competition in the UK in the interests of consumers. If we look at it from an international perspective, actually the fact that we are known to have high regulatory standards and a strong sort of ecosystem around it, around financial services and our common law jurisdiction, these are all aspects which are important for the UK's competitiveness. So the way that we are set up with our objective, and as Andrew said, the overarching remit letter is probably a good balance.
Lord Cavendish.
Yes, my world has been entirely declare an interest in SME sector, and I'm interested in small business, as my colleague Lady Neville Rolfe is. I would make the point that somebody needs to look at competition rather strongly, in that I'd say that my sector, not to mention very small business and the sole trader, has difficulty accessing finance, and that finance tends to be expensive. Do you have a role there? I perfectly understand your reservations about competition.
Right, well this is quite a big one. One of the issues that runs through the FCA's world, actually rather differently to the PRA, is what we call the regulatory perimeter. So this was, the way the legislation is set up, it defines activities that are regulated, and so if you sort of sum up those activities, you get a sort of an area. The perimeter, I have to say, is extremely complicated. One of my colleagues describes it as like the coastline of Norway. It looks perfectly simple when you view it from far enough up in the air. I think the Norwegian coastline is something like 26 times longer when you actually sort of measure it. Or something. It's unfortunately extremely complicated when you get down to the level. It's, as an aside, it is very interesting that many of the most difficult and controversial issues we deal with have the perimeter in common. It's activities that are either right at the edge, just over the edge, or involve complex activity through the perimeter. Small firms is an example of this. So small firms are not actually within the regulatory perimeter as such. Some are because they're so small that they're sole traders, for instance, and they do fall because they're more really classed as individuals than small firms. But it has been an issue for us because, as you know, there are very well-known problems that we've had with banks going back really to the crisis and the immediate aftermath of the crisis, of how small firms have been dealt with, also in terms of access to finance. And it has been a problem for us as to how far we intervene in an issue that is either at the perimeter or beyond it. And it goes back to also the questions we've been discussing this morning about how much regulation do we want? And it isn't easy. On the whole, the decision has been taken by the government not to extend the perimeter in that respect, particular respect. That's fair enough. And I understand why, because in many ways I think the origin of where the perimeter was put was a desire not to burden small firm banking, particularly with the overhead of regulation. It has left us, at times, somewhat limited. We have in recent years, I would say, somewhat gone beyond probably how the remit was interpreted in the earlier part of the life of the SCA, because we've frankly seen the public, the public interest and the volume of public interest has really caused us to look harder at what we can do and how we can use our voice at times. But it's a good illustration of the complexity and challenge of the boundary of regulation.
Thank you. Lord Turnbull.
Trying to go through the items we covered today. Firstly, are there some things that are really, really immediate? Well, in the next, say, 3 months, which of these issues that we've come on to do you think are going to be the really sort of 3-month issues?
Well, maybe I pick out one, which is there has been a commitment made both by our government and the EU to complete, or attempt to complete, I think is how it's worded, the equivalence assessments by the end of June. So that is a very live issue. Our team is already going. As Mr. Bailey said, this ought not to be tremendously demanding, given the position that we're starting from, but nonetheless there are some things to be gone through. What I'm still in the dark about is exactly how our colleagues are going to pursue that at their end, which of course lands on us. I suspect it will land in the form of an extremely long questionnaire, which we'll have to fill in. So that I'm not worried about it, but that, if you ask me for an immediate thing, that's the most immediate bit of this for us.
Yeah, that's the same for us. And the Commission has said that that you will proceed immediately to equivalence assessments. So that's what we're prepared for as well. Also supporting the government on free trade negotiations, free trade agreements. And for us, during the course of this year, as we did before January, we'll continue to look at how things evolve and what are the issues for the industry, and make sure we take a pragmatic approach and communicate to the industry in a timely way.
I think the one I would add is that we're on day 12 now outside the European Union. I mean, we obviously are no longer participating in EU fora, but it is important that we maintain the sort of close regulatory and supervisory connections with the authorities in the EU, because of course we've got such close connections with the firms. And now we've been I think we've all been very focused on this, because obviously we've been anticipating it, but now's the time when we've got to make sure that the lines of communication are still there.
There's one other theme that's sort of rumbled underneath all this. I like this distinction between those things which are dealt with at the technical level, where kind of rational economic man or woman prevails, and then when it gets to the political level, where I suspect the mercantilist instinct is very strong, is whether can we prevent bits of the EU thinking this is a great opportunity to steal London's business, even if it doesn't really make sense for them or the EU as a whole or globally, but it is a very very opportunistic temptation.
Well, I think that temptation is there. It has, well, to exemplify your point, it has been the case even within the last couple of years that with the impact of all those factors upon our status within even the technical fora, a lot of stuff better if it gets sorted out further down. I don't think you can entirely get away from that, but I do think there's a chance to conduct the equivalence work here on a technical basis and reach a clear view. And although there, of course, will in the end be a political decision on that on both sides, I do think a negative decision based on technical advice to the contrary would say a very big thing about how the EU approaches equivalence to the rest of the world.
I mean, give an example which we've been much involved in, and it really goes to the question of the, I think of the cost and risk of fragmentation. Is something called the share trading obligation, which was little understood before it probably surfaced. About a year ago, wasn't it? I guess.
Yes.
And what the share trading obligation, again, you're sort of into the world of MiFID, essentially says is that absent equivalence, EU parties resident in the EU should trade shares in the EU. Now, obviously, that was relevant actually in the Swiss case, but it was also relevant. It would be relevant here because obviously a lot of EU share trading happens in London. It's very well established. Our view on this would be, and it sort of comes back to a principle point actually, that the principle we always want to see is best execution. The firms are getting the best execution for their clients. It doesn't really matter where they get it, providing it's a fair market. But we're not in a sense. Our intention is not to say it must all be here. It must be done under the principle of best execution. I think your mercantilist point is absolutely to the fore there. I think it'll be very interesting to see where this really comes out. It can be solved with equivalence. And it may well be. If it went the other way, I think that would be a very interesting test of this question.
Baroness Neville-Roy.
Follow up, you've got a good list. Some of us are going to Brussels at the beginning of March. Obviously that helps with this influencing and continuing relationships. Is there anything other than the list you've already given Lord Turnbull that we should be thinking about in those dealings?
I think I've mentioned the main ones from my point of view. I think it does come back to a point maybe that Trenchard was raising, which was, I think it's better to acknowledge that we're moving into a process of managing divergence here, because if you enter equivalence, some kind of a notion that you're going to stay exactly the same, well, that will rapidly, I think, come asunder, and it could come asunder in a way that caused feelings of bad faith, and it would be better to be plain, at least in my opinion.
Are there any existing models of managing divergence?
I don't think there are. Not in
other than the framework as it exists, which is that it's two independent countries that have their own jurisdictions, their own legal history and regulatory history, and they evolve differently, but they deliver the same outcomes. And that's what exists currently.
Yeah, it's a way of doing it,
Yeah.
Divergence goes both ways. Are there any areas we're expecting them to diverge from where we want to go?
Well, I think we mentioned one of them earlier, which is Basel III. Where they will go on that.
Yes, I think it's quite likely that, I mean, in a way it's almost inevitable, because absent us at the table putting our point of view, unless you think we've had no influence on regulation at all, it will go in a slightly different direction. And as Mr. Bailey was saying, I think the next leg of Basel III, which we call Basel 3.1 and the banks all call Basel 4, this passes for a joke in financial regulation.
As good as it gets.
As good as it gets. I think there'll be different instincts about, broadly, I think we'll want to go firmer on it than some of our colleagues will.
Okay, well, thank you very much indeed for that, for your time and for your evidence. And the public evidence session has now ended, and the committee will resume its private deliberations. Thank you very much indeed.
Room 4A